Join our new, simpler, free room where we break down the foundations of our trading for those who are looking to gain financial freedom in the markets. Check out Simpler Stream Week from June 21st to the 23rd for live market analysis. And guess what? It's all free, right here on YouTube.
Hey traders, Raghee here, and in this update, we're going to talk about two different ideas for not just going into tomorrow with the FOMC, but also what the scenarios are with a 3/4 of a point rate hike baked in right now. There's expectations for a 3/4 of a point rate hike. What happens if we get the 3/4? I would not be surprised to see maybe kind of some steady markets, maybe even a little bit of a move higher. You might ask why. Well, that's in line with what's expected. If, however, the FOMC goes with only a half-point hike, look for a relief rally into which I will be absolutely open to getting long puts or short the indices. However you want to do it. Go buy put options in the S&P, SPY, SPX, or just short the MES Micro or ES Mini S&P. Same thing goes for the NASDAQ. Same thing goes for the Dow. All right, so those are the two considerations for what we could see tomorrow. But really the game is going to be played not on this chart, but on this graph. June, July, and September target rate probabilities as reflected by the Fed Fund futures. As the statement comes out, these are going to move pretty dramatically. As the press conference is beginning and continues 2:30 p.m. tomorrow Eastern, these again are going to be quite volatile. And the reason for that is, okay, we've got our 3/4 of a point or half point hike, whatever it is. June is done. Are we going to expect a much more aggressive approach to July, to September? Do the dot plots move beyond a 2.5% central bank rate by February? Is it going to happen quicker? See, this is really where the game is going to be played. This is really where we need to be paying attention. Quick tip, head on over to the CME group, look up the Countdown to FOMC website, and jot down around 1:30, 2 p.m. before the announcement, jot down what is expected for June, July, for July and September. Heck, you can even go out to November. Take a look at what is, or take a snapshot, right? Take a screenshot and look at what we had before the rate statement and whatever rate hike we're going to get. And after, right? You want to look after the rate statement and hike and after the press conference. How does the dust settle and what are traders and investors expecting? This is where the game is going to be played, gang. All right, the other thing to do while we're getting so much confusion and angst about what the Federal Reserve is going to do. Look, this morning we traded gold. We day traded gold. We day traded the crude oil market. Before it rolled over, we had a nice buy. Shorted gold off the HPMRs. And we also took advantage of movement in the indices, taking advantage of the opportunities to the long side initially, then to the short side, looking for opportunities for where we have clarity on directional bias, okay? And that is really where, for summer and for this environment, where a lot of traders are going to feel a lot more comfortable saying, you know what, Rog? Yeah, I don't want to have to play this FOMC target rate probability. Will they or won't they hike 3/4 of a point or half a point? I don't want to engage in any of this. I don't want to have to worry about trades that I take on Monday getting dismantled by whatever news. I mean, notice what happened in natural gas today and crude oil. I don't want to worry about that stuff. I want to stay nimble. And that's absolutely fine. I like to mix both, quite frankly. That's absolutely fine, but I get it. And this is why this Thursday we're having a webinar. So Thursday, June 16, 8 p.m. Eastern, I'm going to be walking through time and volatility, the day trader's clock, as well as looking at volatility-based support and resistance. So day trader's clock, what does that mean? What is the clock that dictates how participation, attention, and volatility ebb and flow in the market? And then how do we measure that? And that's what these zones, red and green zones, do. And I'll talk through how I developed these. These were first developed in 2010. They existed on a spreadsheet. Then they morphed over time into this indicator. But it was a process I created back then using historical volatility. I'm stoked to show you how we're doing this in ETFs, in futures, and in stocks. So pencil that in. We'll have the class, by the way, on June 25. So if you want to pencil both those dates in, we'll absolutely be gearing up for a summer of day trading. All right, gang, that's the plan for tomorrow. That's the plan for the rest of the month. And I will see you in the next update. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.